Hello, everyone. Welcome to our Friday edition of Trend Following Trading Club. It's good to be back. It's been a big week. It's been a great week for trend following the commodities, I guess. It's my big position, and then short stock indexes, and I'm getting crushed in my short interest rates. But I think overall it's working out for me. So that's good. And this is a magical time, a great time. And boy, it doesn't get any better than this. Every time I read something or put something on Twitter, I just think about so appropriate given all the surprise, shock, uncertainty of what's going on and how we've got some good positions on. And it looks like they're very scary positions too. Some of these profits are just, I try to stay away from the charts a lot and try not to look at things too much. The profits are destabilizing to some degree, maybe more so than a choppy period where there's winners. So, anyways, whatever thoughts you have about that, I'm interested in hearing about that today, about your trading and what's on your mind. I put in there sort of as a placeholder because I'm very bad at coming up with topics. I like the way Derek does it. I need to do a poll or spend more time uh, guiding us to maybe a great topic. But ours so far has been more freeform and whatever is on people's minds or whatever Richard and I start shoving down your throat, I guess is honestly how it goes. But feel free to suggest some other subjects. I put in there like, who are the best traders in the world or something like that. So really, I got to thinking like, how would I even decide that? How would I? What are the ways that I would want to determine that? I mean, I get sort of enamored by trend followers, of course, and then some of the global macro guys who don't talk about trend, you don't talk about value and fundamentals. They just kind of show up in the news and on Bloomberg with all these profits, big funds, and all this money that they're making. And so it's kind of fun to see and hear about that and all the billions that they make. It's kind of interesting. But of course, if you follow my Twitter, you've seen that I really enjoyed the last week's podcast with Richard and Niels, and I'll talk about some of those to get us going. But they're really good. Richard is really insightful, and then of course Richard says, and I tweeted this that so this could be the answer. A long-term track record is how you decide who the good traders are, and the quality of that track record. That's really a good idea. I mean, I really like that. Staying alive and being staying in the game. That was really hammered into my head in the early years. Whatever you're doing, whatever we say to you, whatever rules we're giving you, they're all can be subordinate to being conservative with your trade level, cutting your positions back when you lose money, doing whatever it takes to stay in the game. And we've talked about that a lot over the past months and months. So, anyways, I'm going to start with Oleg. How you doing, Oleg?
Hi to everyone. Hi to everyone, guys. I'm very happy, especially today. Especially very happy to be with you, to be here because I can't write anything in Twitter. I can only read something in Twitter because it doesn't work properly in Russia. And I have heard and I have read that maybe VPN service can help me, and I will try to download it, and maybe I will be in Twitter. So this week or so, and I was afraid that there will be a similar problem with another messengers like WhatsApp and Clubhouse and so on and so forth. And I want to say that here propaganda machine works in Russia on the full speed. I don't want to say much here, a lot about this because it's maybe not very safe for somebody who speaks so. But Of course, I'm very worried, and even I want to say that my wife said that when she get known about the war, she said, at the first time in my life, I'm ashamed. I was proud that I'm Russian, and the first time in my life, I'm ashamed that I'm Russian. I'm not proud anymore. But of course, it's not fault of people. Of course, I have said this before. It's not fault of the people. Maybe only partly, but not most of the people. People want to live happy lives, not this awful situation. And so I'm glad to be here, and I really hope that my Twitter problem will be fixed. I can write anything there, and I was very impressed, as always, by podcast with Niels and Richard, as always. Very insightful. Every podcast, every episode from the first is very insightful. From the episode number 1 to episode number 181 are very insightful. Every episode is unique for me.
Hi, Oleg. Hi, Jerry. Hi, everyone. Actually, Oleg, I'd be interested to know, where are you up to in your summarizing? I know that you're going right back to the beginning of the Systematic Investor series and summarizing. So where are you up to at the moment?
I'm sorry, but I didn't understand at what episode I am summarizing now.
Yeah, so I noticed, I think you had podcast 12 or something like that, which you provided summary notes on Twitter for. That was the last time you obviously had access to Twitter, but I just wanted to know how you were faring in your summaries of all of the episodes.
It was a very interesting story for me personally. First of all, I began to listen the episodes in December 2019, before the New Year Eve. I began to listen it systematically every day, and I understood how powerful and insightful it is. And so from that time, when I listened all the episodes and did my notes, firstly it was notes by system notes, those that is very important for me for building my system. And I had built my system in a such way that I had even profit in March 2020 in Corona crisis, only because of these episodes. In fact, because I began to trade long term, I began to be less risky, and a lot of this stuff, a lot. I began to trade breakouts methods, more disciplined way, maybe. So, and after that, I decided to listen it twice, and maybe near 3 times I listened all the episodes, and I did a notes. But this time I decided that I will. So I had a lot of notes in my notebook. I have already, but now I decide to listen it another time, and doing it. I'm not even looking at that notes that I had done before. I'm doing it so like I listen it the first time, and it's very important for me. I feel how it helps me, how I feel focused, and I decided to maybe it will be like to share with people with this, and people will discover the podcast. And I think it will be because of this, in fact, because of this systematic investor series. I had a dream for I traded the markets from 2007, from January 2007, and I was dreaming to have a knowledge, to be a real professional trader. I was dreaming for maybe 12 years, and I have discovered podcast in 2019 only, and I was dreaming about this. And when I began to discover something, to read something, or to listen something, I understood that I don't know how can I trust this, and I thought that the best resource for me is a backtest. So I understood that trend following is a very good way. I didn't know a lot of things, but I did only backtest and read only a little because there was no confidence in what I am reading. I saw a lot of different information, and I even thought that maybe fundamental global macro guys know more than me and it's a higher level, but I didn't understand how to be a global macro guy and how to combine this because I didn't saw the sense, and I have told before that I was get very happy when I understood that there is no sense. I get really happy. Yeah, so it's very important for me, very important to do every day a step of something. I'm listening episode to looking at the charts and to do something that will improve in me, and it's it's a very big deal for me. I feel very big purpose. I liked the idea of changing the narrative and that people will understand the trend following. It's a great idea. It's not like you said. It's not because we are dumb or we are not smart enough we are doing so, and because we understood how to deal with the complex systems, a lot of different complex factors, a lot of unprecedented things in history, a lot of things that we can't predict, and because it almost never we have seen such things like corona crisis and something like that, and we in fact we have we must not to think what must we change now with this situation. We must not think about this. We have a model that will work. We have a model, and I believe in this model, and I think that there was no such situation. It cannot be so. The trend stopped to occur. I think it can't be so. Maybe it can be so, but in fact, if it will be so, it means that the global markets will be stopped. We will not have global markets because it's a structure of the market to change the price. Changing the price changing is the part of the market, and if we will not have this part of the market anymore, we will not have maybe a markets anymore in a way we see the markets, we understand the markets. So here's my point.
Yeah, that's great stuff, Oleg. Yeah, I commented on Twitter how I had a look at wheat last night. I'm in wheat, and I was looking at in a way I shouldn't have looked at that position in wheat because I saw how far away my trailing stops were from current price, and of course the temptation there is to move those trailing stops closer after these such moves. But sitting on my shoulder was Jerry Parker saying, "Don't do it. Follow the system." So thanks, Jerry. You saved me again last night. But I'm just going to keep my head out of the screens at the moment and just let all of this unfold.
That's right. That wheat has that's a good chart to look at. And, in my opinion, you should go back a year or so in wheat when it made that initial breakout and just see how well your system did. When I say long term, that's the perfect chart because there was so many opportunities to get shaken out of that trade. And it lagged behind corn and beans. It was the weakest one, so relative strength. Don't even bother. Just add to your corn and beans, oil and meal maybe. And but I don't look at relative strength. And I trade. You'd be shocked how many wheats I trade. I mean, I trade the four: Chicago, Kansas City, Minneapolis, France, South Africa. I think that's it. And so just being long term, kept me in that trade. It would have these vicious spikes down and then go right back up. It had one of those this week or last week, limit up one day, limit down the next day. And you do ask yourself, how dumb is this? It can't keep going, and it's too volatile. And now I see the benefits of vol targeting, and because it is the poster child for, I'll probably make more money, relatively speaking, in wheat than anyone else on the planet, unless they trade wheat only. And yet my drawdown is more than likely going to be pretty uncomfortable. I'm not going to like it. I trade so many markets that it's not going to really feel too bad money wise, but psychologically, I'm going to not feel good about that wheat trade. Just say it right now. I'm not going to maximize that profit, to follow the system, to maximize the profit over my entire portfolio. I've got to treat all these markets the same. And this wheat thing is not going to be so much fun. Um, but it really is a good way to bring up a chart and see where you kept getting in and out of wheat, or if you're still in, like me, I would just say that's why I like my systems. It's not just maximizing the profit, but all the nicks that I would have gotten in and out, And that's why I don't really classify Black Friday as too much of a black, because I don't know. Those trades were really profitable. They got crushed one day, and then they kind of went back, and most of them proceeded like they were trending earlier. And I think it's just really mandatory to, if Black Friday freaked you out, then just trade smaller. But really, it's the benefit of letting these profits run and not having that trailing stop too close. We're just seeing the benefits this every day. I mean, this is the magic period. It's not going to get any better than this. And then when the reversals come, it probably won't get any worse.
Yeah, exactly, Jerry. Look, I was actually thinking back to that Black Friday, thinking, at the time when I commented on Black Friday, I thought, oh, this is nasty. All of my equities have been hit hard, and at the time it was fairly ugly. However, looking back in hindsight now, it was probably the best thing for my portfolio. Is it just, eliminated all of this risk out of the portfolio. So I didn't get the inevitable, when we started going into this big bounce we had. I think it was a few days ago. When was it? Saturday or Friday? I think it was last Friday. I noticed a big bounce, and I thought, oh, here we go again. We're going to get this short downturn, and then we're going to get this massive bounce up. But ever since that day, everything's been sweet. But yeah, Black Friday was actually a good event in hindsight to clean out this risk out of my portfolio.
Well, I can agree with that to some extent. um, if I had losing trades on, and I definitely give you credit for um, helping me see that taking these small losses, whereas on the back test it may look like you could use a stop loss or not use a stop loss. It's my analysis is it doesn't really change your performance very much on the back test, but it does clear out some of the risk that you don't have any business taking. If it's a good loss, why just get out of it. But I wouldn't want to. I wouldn't be happy with my trading if it cleared out some risk in those wheat trades. No, 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 no. I mean, if it hits my exit, then fine. The 100-day, 200-day low or something like that. But those sort of wide parameters is what it takes sometimes on the back test to maximize your profit. And you have to sit there and suck it up. And so watching wheat make new highs shortly thereafter, I would not be able to convince myself, well, Jerry, that's fine because you cleared out some risk. No, I got out too quickly. The system's too quick. It's too short term, or I overrode it because of all the vol, and I got on 5 contracts of wheat. Who does that? That's crazy. And so no, I could not put that in the pile of, well, I'm clearing out risk here, because it was a massive. There was no reason to get out of those wheats. The profits weren't big enough. Back in the day, with Rich, he told us not to trade wheat. Like, wheat doesn't trend very well, so you don't even have to trade it And then I remember years after that, when I was trading all four of those wheats, my friends would say, how did you make so much money last month? I'm like, oh, because I'm trading like 4 contracts of wheat. And they're like, wheat? We don't even trade wheat. Rich told us not to trade it. So, like, they would say, like, trade all the markets. Diversification is the greatest thing ever. Just like we say on this. And then they would carve out an exception. Yeah, we don't like wheat. It's not very trendy. So I'm like, well, screw that. I'm going to go with the first thing you said, not the last thing.
And I think that, of course, if we have enough money, and so it's we must create all the markets as possible, of course. But if we have, for example, 200 United States dollars or 300 United States dollars, I think we have no choice here and must select. I'm talking about my opinion because I understand the situation where traders don't have enough money for being fully diversified, and so here is a choice. And I think on the one hand, it's okay to take the market that wasn't trending a huge amount of time, so for maybe for 10 to 15 years, because we have maybe we may think that it will be in a trend soon, but on another hand, I think it could not be in a trend, or maybe on 5 or 6 years, or so on and so forth, and we can't predict that. And the problem is that, as I have said, we have no choice. We must select the markets because of deposit is not very huge. And so here I think it's, for me personally, better to trade the markets that, like, maybe small markets like orange juice, and not better, but better than take a market that is not trending for 15 years. It's not the best approach, I understand this, but I think no choice here.
Just a quick question, because I know Jerry had a couple of disagreements with me this week. The first question goes back to Jerry about the ethical stance we take in the markets that we trade in our portfolio. And I do think we really like Neil's response. However, I was putting forth an argument saying that because we apply this process which doesn't sort of have any pets in our portfolio, in other words, we treat all markets equally, does that mean that we should elect not to trade certain markets due to ethical reasons? The conversation was about ESG. I'd like to hear other people's views regarding that. And the second question, Jerry, I did a bit of a two-step when I was talking about risk adjusting, and I hope in the Twitter feed I was able to give a satisfactory response to relay what I was actually meaning in that term risk adjusted, because I know you hate that term because it does smack of volatility adjusting, but this is specifically not volatility adjusting. It's using these preferred risk metrics as the maximum drawdown, the KGAR, the MAR ratio, or the serenity ratio as a measure that trend followers adopt, as opposed to other risk metrics such as a serenity ratio, which are totally unsuitable, and that does accommodate this volatility adjustment. But I hope in that Twitter feed I was able to convince you of what I was meaning there.
Oh, I'm easily convinced by you, Richard. So, well, let's take those one at a time. The ESG I thought was interesting. I mean, Niels, when I retweet some of the quotes from the podcast, I seldom quote Niels. So I was really happy that he had a couple home runs, and you're hitting it out of the park all the time, and so it was great. I was happy to show Niels some love, legitimately, because I liked what he said about ESG. But I'm obsessed with trading all these markets. I've already been on record as saying I want to trade China commodities. So I was doing some sort of step there as well. But I do think that it's so important, to trade as many markets as possible. And the commodity markets in China would just be a great addition to the portfolio. And I think So I don't know how to handle this. I'm going to be very careful and not go on record as saying um, uh, I wouldn't trade China commodities. I have heard other people talk about China in general in the sense that they wouldn't trade any markets in China because they don't trust the regulations, and it's not Western style markets, and regulations. And so that would be good enough for me. And I think that was the G part, maybe. I think that's what he was talking about. He may have said something about human rights as well, and that would be problematic too. To be the lone person, and go in and be asked by someone, oh, we want to know if you trade China commodities. No one else is trading them but you, and you're like, oh God. So you wouldn't want to do that. But I guess the G part, where I was caught up in some of that in 2020, where I almost put a stock trade on. It was a coffee company. It was pretty famous, Lucan Coffee or something like that. It was a new company in China, and they were falsifying their earnings. And I didn't go long. I almost did, and the stock basically went to zero. So I think there, is probably our out. Um, if we as much fun as it would be and profitable to trade more markets wherever they are, I wouldn't want to do that in a country that wasn't protecting my client's capital and legitimate play rules. Everyone was playing by the rules. But yeah, I don't want to commit to not trading China commodities. I don't know. What do you think?
Yeah, I wrestled with it. It was a very good point from Niels, and it made me question my stance, my ethical stance. But see, I always had this opinion that trend following was a particularly ethical model. And the way have always justified it is that it's not what I regard as an exploitative model. It's not, in the high frequency game where you're using exploitative practices to get higher latency to front run, other orders. It's not a particularly exploitative technique. I suppose it does rely on the principle that we thrive when predictive models break down. So I suppose that is a degree of exploitation, but I feel as though that's exploiting an arrogant trader who believes that they can predict the market. So I'm comfortable ethically in trend following in that I'm applying this counterintuitive approach, which is bringing people back to earth, because it's quite a humble trading profession. But then when I get questioned about, well, then why do you trade, crude oil? Why do you trade Brent? These things are contributing to global warming. Why do you trade, China? Why do you trade this? And I tend to think to myself, well, we're not always long these things. We often go short in these things as well. If you're shorting these, hydrocarbon assets, isn't that good? So it's tough, and I tend to think that if you do start adding this added complexity in your models by restricting the markets you trade, this edge that we have, which is a fairly weak edge, even though it compounds over the long term to produce this great long-term performance. If you start, reducing your universe to only trading ethical assets, you're significantly restricting the opportunity for your models to generate an edge over the long term. So I'm not sure how ethically we should trade this, or whether we should put the money we earn from this process into ethical pursuits as opposed to the technique itself.
Hey guys, when it comes to China and this ESG, I watched a video by Ray Dalio that was uploaded to his YouTube channel yesterday. It's an addition to his Principles book, how to deal with changing world order. And basically, he goes there back to history, how the Dutch Empire was followed by the British Empire and the pound as the reserve currency. And then now the US Empire and the rise of the US after the World War II and the dollar as the reserve currency. And basically, at the end, he shows visually and tells that China could be the next superpower or world power number one, and shows how the US is slowly declining and China rising, and it's been talked about before. And one of my thoughts that popped up to my mind was that if China is kind of an outsider or in the West, in terms of ESG and human rights and everything, like how could the Chinese currency become a reserve currency? Wouldn't that mean that the West should like trust it, use it, and kind of like look up to the country as a whole? So the way I see it, I couldn't imagine at the moment, at least, seeing China's currency as the reserve currency in the world, so that the West would also accept it. Or what do you think about it?
Yes, Marcus, I think it's contingent on this word called trust. And I can't trust the counterparty risk associated with China at this point in time, even if the currency did change into their denomination. At the moment, I need to trust the assets I trade, and that is one aspect. The counterparty risk, that's a risk. It's not a sort of an ethical statement, but yeah, I don't think we're ready yet to transfer over to China. There's this gentleman on Twitter by the name of Simon Kuchester. He produces maps, and he showed this map over the last 50 years of the change in economic trade situations between countries in the world. And it just shows how originally there was this vast sort of dependency on the US, and over the course of time, countries have slowly changed their trade dependency over to China, and it has almost been an invasion in the economy. You can see that what was blue, which was sort of mostly trade going to the US, the map slowly turned to red as you realize that all of these countries were slowly progressing over to China as a dominant economic partner. And I assume this is a trend that's going to continue. So, but for me to trade them, I would need to have trust in the execution of orders, the counterparty risk, all of that sort of stuff.
Okay, if anybody else wants to talk about that, just weigh in, or we can move on to oh yeah, risk adjusted. See, I thought I was supposed to not like risk adjusted because it's code word for not following your core rules, volatility targeting, heavy-handed portfolio overlay of your system to where almost the core breakouts and ATRs get overwhelmed by what's going on in the portfolio, other markets, and so you're not really exercising the proper rules because everything can be justified by these portfolio rules. And this is the only way for classic trend following. They must throw in risk adjusted. It has to be thrown in there because that just needs to be the norm. We don't even have to discuss it. Anybody who doesn't pay attention to risk adjusted, I mean, that's laughable. So we can ignore that because it doesn't work for us to take small losses and protect capital in that way. This has to be this is part of our schooling and our philosophy. We can reject this idea that we have to be classic trend following. We can use bits of trend following, but really we're all on the same page, aren't we? We have to have this consensus here. If you're not in the consensus, you're out. And this risk adjusted is something that must be inserted because maximizing terminal wealth and making the most amount of money and preserving capital, not preserving open trade profit, but preserving your closed out equity and your initial capital, is not going to work for us because we're not able to insert all of these other great ideas we have, which is essentially taking profits before a long-term exit gets hit. We have long-term exits, but by the time we get out at the 200-day low, 150-day low, 2/3 of our position is gone due to these other factors. So I find it hard to understand also how, if a person was to use these other methods, the non-trend methods, the take profits, the fall targeting type reduced risk ways, that would not also show up positively in every type of drawdown or any type of reward risk metric. For instance, whoever gets out of all their wheat last night could have almost a Sharpe ratio on that position of infinity. They had no drawdown basically, or if you get out at the very high of something, I could go on to make another 100% in that trade, but I'm going to have a nice drawdown at the end. So my Sharpe on that particular trade is never going to measure up, or my drawdown is always going to be impacted by letting the profits run. I don't understand how these bad ideas, according to Jerry, won't somehow eventually positively impact your ratio, whatever ratio you choose that has any sort of thing based upon drawdown and no, it doesn't improve your terminal wealth. I'm going to get an A+ in that category of terminal wealth, the classic trend follower, but he's also going to have the worst drawdowns. It's going to seemingly look like he is more efficient and better.
Yeah, look, I totally understand that, but I think that the symptoms you're talking about, like when I'm referring to this term risk adjusted, what I'm talking about is a basis of selecting selecting your strategies, etc., over this long sample size that at the portfolio level produces this greatest asymmetry. And where I think the difference, or where I think the importance is, we need to select the portfolio that produces the best asymmetry for long-term compounding. So when you're comparing different programs like Mulvaney, Jerry Parker's Chesapeake, Dunn Capital, and all of the players, TransTrend and those sort of things, we want some form of risk metric to be able to identify, well, who is producing the greatest asymmetry independent of position size. So my concern with some of the programs, like Paul Mulvaney's, I love his approach, but he is highly levered. I believe that that volatility we see in Paul Mulvaney is because he is aggressively applying leverage in his classic trend following models. Because when I compare that to, say, Chesapeake, I see that it's almost perfectly correlated to Paul Mulvaney's. However, Jerry Parker at Chesapeake doesn't play as aggressively as Paul Mulvaney. Now, when you look at, well, who produces the best compounded result, independent of the leverage, and you find that, well, really it's apples for apples. What we're seeing with Paul Mulvaney is just simply the application of higher leverage to his models. And what you can find when you excessively apply high leverage, you actually find that there is a drag on that compounding from those drawdown periods that does stunt your compounded wealth over the long term. So whilst Paul might have these magnificent periods of time where he accelerates to the moon, there are other periods of time where he gets these vicious drawdowns, which does compromise his long-term compounded wealth story, independent of the position size. So when I'm talking about risk adjusting, I'm not talking about a method to smooth the portfolio. I'm talking about a method that optimizes basically your leverage, your strategies, your portfolio selection to produce the greatest asymmetry that generates this long-term compounded wealth, if that makes sense.
Yes, see, we're always wrong when we anticipate that we disagree. So I agree with all of that. That's great. Great. I wanted to ask one question, and I want other people to jump in here too, because I find this very fruitful discussion. In what way would you guess, or maybe more than guess, that because the one thing that popped into my head when you said when I read your tweets and just now is I feel like that what you're seeing in my trading might be the benefits of not using the daily AUM to calculate the quantity for today's trade. So I'm not I'm using leverage, and but I'm not changing my trade level often, or certainly not using today's trade level with all this open equity, open trade profit. How much does that play into us looking a lot smarter than we probably really are?
Well, if pound for pound, if I compare Chesapeake with Mulvaney, I'd be investing in Chesapeake, and that's not just to, pat you on the back, Jerry. It's because you're using realized balance as a way to reduce the impact of leverage. I think that's a very important measure, as opposed to the open equity. At any particular day, you're using the realized balance that dilutes the aggressive leverage that's introduced into a portfolio. Secondly, you weekly compound. You're not sort of continuously compounding. You're stepping up over a period of time with your compounding. So you are getting the benefits of compounding, but it's not sort of giving you speed wobbles like some other firms, which significantly does detract from compounding. So I think it's smarter. What you're doing is smarter in relation to the management of wealth, the protection of capital. I personally, you can't go in trend following like a bat out of a cave. You've got to be conservative. You've got to be prudent. You've got to slowly build your compounded wealth. You're always looking at ways to eliminate this drag created through drawdowns on that terminal wealth at the end. So that's how I'd view it.
Is anyone else using multi-duration trend following where, I know most are, I think, longer term, and I have the long-term turtle system as well, and I'm still in those trades. I was just curious, we always talk about sharp or vol targeting, but does anyone else use some shorter time frames like I do? Not necessarily exactly like I do with the point and figure, but I was just curious because that does take some of the risk off as far as the returns. But I know at the end of the day, the math says it's not as profitable as just staying in. Where my longer term, like Jerry said, you're in wheat since last year, so just curious.
I'm sorry, I want to say my opinion here, short review, the opinion, that I thought about this today, that I'm glad that I was for many years, I was a short-term trend follower trader, because I had a very good training. It's not good in a term of performance, but I have a very good training there, because I looked at the chart a few times a day, and now in a crisis environment, and in every crisis environment, if you have such a training, it's maybe okay for you to look at the chart. It's not unusual to look at the chart for 5 times a day, and so I'm even thankful. It's a good training, but in terms of performance, I decided that when I began to listen top traders and plug systematic investor sales every day, I decided for me that I'm not a short-term trader anymore, and I like to trade from a long term, from 100-day breakouts. So here is my point.
Brian, the way I do my workflow process, which I have put up on Twitter, the outcome of that process is that, let's say there's an individual market like wheat, I might have 5 different or 10 different trend following models that are targeting wheat, and their lookbacks do significantly vary from what I'm terming a short-term to medium-term to long-term lookback. And when I'm talking about short-term, maybe 50-day lookback is probably one of the shortest models. So of course, it's all sort of dependent on your interpretation, but that's how I'm viewing it. So the reason I'm deploying these multiple systems is that when you have an individual market and then you start compiling lots of different individual markets together, you'll find that the system diversification that is within each of those single systems actually assist in reducing portfolio correlations. Because the independent systems give you diversification entry, look back diversification, etc., which at the individual market level does reduce. So rather than having, say, one or two models for a particular market, I might have 10 models that will offer this diversification potential. So when I'm compiling those markets together of 10 models each, these offsets occur by the system correlations. So they're uncorrelated in nature, which allows me to therefore trade at the markets that are more highly correlated than what a trend trader who's only got maybe one system or two systems deployed for that market. So they might not be able to trade both crude and Brent, but with my system diversification, I can trade them quite comfortably because the system diversification is breaking down that degree of market correlation that exists when you compile them together.
And as you mentioned a few weeks ago, it's also an edge that trend followers have over people who don't use trend following and try to use correlation as one of their ways to reduce risk. I thought that was very insightful as well. But I agree totally. The interest rate markets are a good way of looking at that. Those trades are probably highly correlated, but I've got P&Ls in the short-term rates that are much higher than the long-term rates, and then I'm getting out of some as they rally, then they go back down. I mean, it's just all over the board. And it's, once again, I think, a reason why it sort of behooves us to focus on correlation of the losses and P&L, and are we stringing a bunch of losses together, which we don't want to do. A lot of small losses together is no good. But when it's all said and done, a lot of these commodity trends or bond trends, the P&L for each one is going to be all over the board. And some of them might be an outlier that you wouldn't have hunted and found and killed if you had have said, oh, they're all the same.
The group's uncharacteristically quiet. It's kind of bothersome.
The topic about the open and closed equity and trade level and adjusting it very slowly. This is something I thought about a lot last year. I think Jerry talked about it a year or more, over a year ago at Top Traders Unplugged podcast, which made me think a lot. And the way I've understood it by now is that, I mean, the more long term you are, the slower you should be to adjust your trade level and trade size. But even though I trade only equities myself, so I'm a bit of an outsider here in the trend following community, but many of the things apply also to my equity trading, and I'm long term and short term both, so I diversify across time frames. So the way I decided to solve it for myself was to lower my trade size, but use the current account size or the open closed equity, everything. I mean, the current balance, whatever it is, and I adjust the trade level weekly, not every day, but weekly. But yeah, for that reason, I lowered the trade size. Let's say instead of risking 1% per trade, risk 0.5%, and so on. So because I have that short-term strategy element also in the portfolio, I felt that this was the way to go for myself.
I want to say, Marcus, that I like your thoughts, your ideas, because I know, because of my research, and I know it quite exactly, that if you trade the quickly you trade, the less your risk size, your size must be. Because if you trade intraday, for example, it's very 1% is a very big risk if you trade intraday because of the noise of the market. Because of the noise of the market, 1%, and so it's important moment. By the way, very important moment that if you are a short-term trader, your risk must be less, and I know this exactly.
Yeah, I think that's. I should know the answer to that, but I think that there is a difference, and but it would just be something I'd have to do a back test on. I think there would be a reason that I would. Well, I know in my head there's a reason for me to prefer the trade level, slow movement of the trade level, and not the reducing the unit size. But yeah, you're right. I mean, it's the same thing, I think, until it's not. So I would be skeptical that it is going to. But I know logically in my head, I really like what I do. But it gives me boldness to hold on to the profits. I mean, think about how much money I've left on the table by not using the daily AUM or moving my trade level up quicker. This is an unprecedented run. And I'm keeping up, let's say. I'm not making 1% when everybody else is making 5. But, and then my drawdowns, I look at the drawdowns, these horrific moves. I just got crunched in emissions, the greatest trend in 2 or 3 years. It's now getting crushed and crashing. And so I trade it small, I trade everything small. And the drawdown is based upon, let's say, I'm close to all-time equity highs. Okay. And so, and I put the trade on with the trade level that's very low compared to my current AUM, or, not adjusted for additions and redemptions, just the amount of P&L profit I've had over the past couple of years. So my drawdown, it's artificially small because it's in that trade, because it's the public is seeing it being divided by all-time equity highs. So, yeah, I think that it's a secret weapon, and it fits right in with this whole idea of protecting profits and protecting your capital and letting profits run. And I wanted to mention one other thing that we can get to eventually, Richard, if you want to mention. Oh, yeah. So I'm still not 100% clear. I mean, I guess I am kind of clear on your explanation, but just to put you, ask you one more thing about this. Okay, so you and Niels have come to this conclusion, though, that there's 2 groups of CTAs, and I'm in one group, and that is Kager, let's say, but Scary Vol. And then the other group that Harold is in is the group that does better with Serenity, I believe. And that's going to be the better group. I think you said this, I think I tweeted it, as it relates to compounding. So we're back to that darn issue again. What can I do to be as good as Harold?
No, but see, okay, I view it as actually there are 3 groups of trend followers. There are classic trend followers. You and I fit into that bucket. There are the Harolds. They've got a different, unique style, but they are 100% trend following. I'd classify them as 2 groups that are 100% trend following. The real bone of contention with me are those that flavour their portfolios with convergent models, pattern recognition, mean reverting, counter trend. They'll flavor up their models. Now, that third group is the one I've got the real issue with, because the reasons for that flavoring of that portfolio is to deliberately smooth those returns, and that compromises the performance. So that third group, you find that over the very long term, they've got a very smooth equity curve, but their compounded returns are dilute. They do not achieve that level of bang for buck. But in these two different groups of 100% trend followers, and I'm not saying that, for instance, some of the classic trend followers, like Paul Mulvaney and yourself, the serenity ratio is good. It's a good serenity ratio, because the serenity ratio is looking at the asymmetry of the returns, the asymmetry of the uncompounded returns. So if you think, we're looking at what is the best uncompounded equity curve we can achieve, that when we do apply compounding to, or we apply leverage to, it gives us greatest bang for buck with a net wealth story at the end. So this is what this serenity ratio actually measures, because it's an enhanced metric to, say, the MAR ratio, because it's not just looking at the single worst maximum drawdown of a 30-year return stream. It's actually looking at all of your maximum drawdowns, and it's looking at the shape and nature of those drawdowns, because it's the drawdowns, or the adverse risk exposure, which is the thing that's compromising that compounding. So the serenity ratio it's pretty hard to calculate. There's a lot to it, but it is quite powerful. It does slightly exceed the MAR ratio, but over the long term, that little extra excess you get does produce this great compounded story. Now, of course, to an investor investing in these programs, they can apply leverage in their model. So they for instance, can, invest in, say, Harold's TransTrend, and in Jerry's Chesapeake, and in Paul Mulvaney's, etc. And they can apply leverage at their end, using a bit of debt and a bit of equity to sort of, spice up the returns even further. But that's a decision they make. But I think, Jerry, when I look at the performance returns of the 100% trend followers, whether they're classic or not, this net wealth story of compounded returns, shows clearly that over the long term, they are producing the highest levels of wealth. That third group of trend, or people that call themselves trend followers, that are flavoring their models with a bit of convergence, they don't meet the grade. With realized balance, we all know that trending environments tend to cluster. So we do know that there are periods of time where we do absolutely fantastically catching these outliers. And there is inevitably, after those times, there's a lot of give back when the market sort of is less volatile, and we're trading these volatility clusters. So you don't want to be excessively applying leverage with compounding, because if you are using daily AUM, or your total equity at any point in time to size your positions, if I was doing that now with my wheat trades, and with my Brent, and with my crude, and with all of the things that are trending now, I will be applying a much higher level of position sizing going forward, based on the trades that have still got to exit. So it's unrealized balance. Now, the assumption is that they're all going to end well. Now, I don't know that, because I'm currently still in those trades. So I could be deliberately, without realizing it, increasing the leverage of my portfolios based on an assumption that they're all going to be incredibly profitable over the long term. That's not always the case. I might get big retracements out of my wheat trade, etc. But by using my equity, I'll be jumping into positions following the wheat, and following the Brent and crude, which is significantly higher than if I was using realized balance. And because we know that these volatility clusters occurs, it will introduce greater drawdowns if you do excessively, apply leverage through using your unrealized equity, or your total equity, as a basis for your position sizing. That's why you do need to be more conservative. Give time for these trades to play out. And also that builds up a degree of sample size before you then decide to lift your compounded treatment with higher position sizing going forward.
Jerry, answering your question about why you can't quite articulate the difference between choosing a lower trade size or an optimal balance between small trade size and more frequent compounding. I think the answer lies, and obviously you know what I'm going to say, but the answer lies in becoming explicit versus implicit in defining your risk parameters and these risk adjusting, which I keep contesting is not reduced to vol targeting in the sense that you guys are saying, but I think I found a lot of very interesting similarities between what Harold does and what I do. Not that I want to compare myself to a very successful investor, but their obsession is in finding different ways of rendering explicit a correlation matrix, which obviously doesn't rely on linear, Pearson's correlation of price. They have a different dimension. They found their own dimension. I try to find my own dimensions. But why do we do this kind of things? We do these kind of things in order to optimize trade size and compounding size to what I keep saying, the opportunity set. And I agree with you. We are all maximizing or seeking to maximize terminal wealth. So the problem in your model, I think, the reason why I can't quite embrace your model, and I try to be very explicit, is because you guys have sort of taken a very implicit approach. You're saying correlation between all our instruments are one, when you actually know that, there's diversification, but you don't account for it, at least not explicitly. And then you're saying, oh, my capital doesn't vary with open profit. I only take my closed equity. Well, but that's another, too simple, assumption, if I may say. And so all these assumptions that you're making, which are very conservative and, they're basically your trademark, but sort of bog you down in making a lot more things implicit as opposed to explicit. So you can't quite figure out, where is the dial to effectively optimize your exits when you have a lot of, AETR exposure, or, how often you should, compound your equity and readjust your trading positions. I think that's the answer to your question, and that probably reconciles our, one of my pet peeves, and I think one thing that I've always complained about, the classic approach is this idea of having to divide open and closed equity, which to me doesn't make sense because no entrepreneur would say, oh, here's my open equity account and here's my closed equity account. So I think that's how I would answer your question. And if I may, a slight cheeky comment, I think you need to become a bit like Dr. Strangelove and learn to stop worrying about risk adjusting and instead embracing it and loving it.
Bruno, okay, so this is why, if for instance Jerry and I start taking a position on correlations, now we've already stated in our philosophy how we are price followers. We are explicitly non-predictive in nature. So if we were to start looking at correlations this way, as you imply, we know that these correlations are fickle. They change. By investing a lot of effort in improving the uncorrelated nature of your portfolio, you are integrating an assumption in there that these correlations are going to be static or stationary. And we know that that's not the case. There's this moving feast that occurs. Things can become highly positively correlated, things can become uncorrelated, etc. So what we do, therefore, is we look at, just like we cut losses short, that is a process that we embed into our systems to manage downside risk. So by using realized balance, that is another process that conservatively ensures that we don't aggressively embed leverage into our portfolios based on the current performance. We're looking at long-term performance. We're not really paying much much heed to any individual trade or any individual month or whatever. We're looking at decades of performance here. So we want to embed these processes that conservatively restrict the adverse risk that we can get ourselves into if, for instance, we put too much emphasis towards correlations. And I know Harold's done very well over 10 or 20 years, etc. But who knows what's going to happen over the next 10 years or 30 years. I do know that classic trend followers, because of their risk mitigation measures that are very simple and well understood, they're embedded in their systems. We know that they've got this open-ended, unlimited profit potential. And we might find that there is a significant outperformance of classic trend followers going forward if we have this incredibly volatile environment. And we might find that those people that paid too much attention to correlations find that they are left sort of treading water when classic trend followers are exploding in performance. So, yeah, I tend to disagree.
No, I understand that, and obviously respect. Everything is not, I'm not sort of promoting and pushing my my approach. I'm just saying, I'm just outlining, trying to answer Jerry's question and give my side of the answer. I still think that you guys, again, correlations are unstable. Yes, I agree with that. But there are ways in which you can you can improve upon that. But at the end of the day, you always have to pick your sides, and you have to pick your evil and live with it. I've decided that becoming a bit more explicit in doing this modeling pays dividend. But yes, I mean I don't have a perfect approach, and there's no perfect approach. I just stress and outline the fact that and Jerry himself was saying it before. There are times when you feel like you're trading too small. Why? Well, because you effectively are choosing a correlation matrix of one all along, so everything is perfectly correlated. And obviously, this is very conservative because there's diversification, but you don't explicitly account for it. So you don't explicitly let yourself trade bigger as opposed to smaller when things are in your favor. And obviously, I understand the opposite argument, which is, well, I know that at times, I know that what today, what advantage I have today, tomorrow may be my harm. So you don't want to do that, but that's understood. I don't want to push for a superior approach because I don't think there is. I'm just saying that risk adjustment allows you to be more explicit in targeting optimal trade size and correlation structures. I think that's a neutral statement that we can probably settle.
Thanks, Bruno.
Yeah, that's all good. I understood a lot of that, but you got to keep giving us your point of view, Bruno, because it'll take me a while to get all of that. But I think I have a tendency to argue both sides. It depends on who's arguing against me. Like sometimes I'll say exactly what you said, which is that actually I think we think correlations, everything can be correlated. It's not. We see the back test, and we see that how powerful the diversification is and how uncorrelated some of the markets are. And then we see, obviously, that they all go to 1, March 2020. And so sometimes I'll say, nothing is correlated. It's all not correlated. It's all different because we're hunting the outlier. And you can get this outlier. And who cares about the open trade equity? When things go to 1, they're all profits, or I have it under control. I have my risk under control. I haven't increased my trade level, and I'm protecting this capital that the two equity curves. I'm looking at the closed and the open, and maybe the combination, obviously, the third. And at some point, when the drawdown gets to be so large, that distinction even falls apart for us, because, being down 50% of total equity, no one, not even myself, is going to say, "Don't worry, Jerry. It's not that much due to if you measure it in terms of closed equity." I mean, no one's going to pay attention to that. It's too painful and it's too devastating. And then, of course, I'll just throw this in. I've mentioned it many times, and that is the closed equity drawdowns are all weighs less than the open trade equity. And so that's a pretty amazing fact for trend following, long-term trend following, classic trend following. But I don't see a problem in necessarily looking at closed versus open versus total. We just treat the wins and the losses so much differently. You know, we're having no tolerance for any sort of drawdown in the losses, hardly. And yet we're so free and easy with these open profits that it seems natural to me to sort of focus in on that closed, which is the initial capital contribution plus the realized profits and losses, and not be so focused on the open, because we are saying optimally based on the back test, we're doing exactly what we should do. And it's totally natural because we're treating the wins and losses so much differently that we would look at the accumulation of these and the account balance totals of the wins and losses and the open trades. So I'm not, anyways, it helps me sleep at night and stay logical in my own mind. And I often think, you know, I could trade so much larger. So I'm buttoned down. I am over trading and obviously correlated markets with Brent and crude and all the currencies and getting crushed in these interest rates recently because they're all acting the same. But I know Bill Eckhart has said, I'm sure he doesn't trend follow and use breakouts. I mean, he absolutely says that. There are all so many people, turtles or derivatives of turtles, love to talk about how bad breakouts are. I mean, I just don't get it, but whatever. And they want to make sure everyone knows they use nothing that the turtles were taught in the 80s. Nothing. We use nothing. Okay, great. Pat you on the back. Great. But he's often, and I'm sure some of these philosophical ideas still permeate his short-term systems. And because I think recently he's even said that, you know, we should all trade larger than we should. And I feel like that sometimes. And then, of course, your fail-safe is this equity cutback if things get too hairy. And so I do think that my max risk budget probably should go up because I'm so buttoned down. Although I will have bad periods and bad days, because these small bets that I place at the entry become very large bets. So the ATR in this current ATR of the emissions has made this small emissions trade that I did 2 years ago pretty darn large, and it's impacting my performance. So this hidden bomb is out there because I'm not vol targeting. It's out there, and it's grown. This position has grown into something that doesn't look too small and manageable. Anyways, I'm kind of
Gosh, I
rambling.
wouldn't be increasing that risk, Jerry. I'd be like, if you compare your portfolio now to what it was 10 years ago, you'll see that you've got so much more diversification in it because of your smaller bet size. If you start trading higher, that is going to compromise your ability to diversify wider. So, yeah, I think you're sitting in this very happy world where you are extensively diversified, that by its nature is producing an uncorrelated result because of the degree of diversification you have. A lot of us sort of have to focus on these, the correlations because we don't have that scale of diversification that you have. So I'd be very reticent to change your risk weighting.
When we are talking that everything can be correlated, there is another side, I think, of this, that everything can be uncorrelated. And I love the story about crude oil that Jerry told us. I love the story about silver, and it's very insightful and very interesting to understand such things, that everything can be correlated and everything can be uncorrelated.
I think another thing too that may be relevant to what Bruno was saying, I'm not sure, but I do think that one of the things that I do is I am incredibly overemphasize. I mean, this is like something I can never stop doing, and that is have these static rules that never change and that allows me to apply these rules in the same way for the next thousands of future trades that I'm going to do. I did it in the past future trades. I'm going to do it in the future trades. And so I want to be able to have these static rules that are not looking at current opportunities. There is no current opportunity. It's the opportunity, it's the sample size that if I do this in this particular way and ignore so much, that I will be able to get the benefits of applying the same rule, the breakout entry, the breakout exit, the stop loss, and I'm setting up my unit size and risk level for each market in January 1984 and not changing it. Oh, but I've got to change it a bit because I'm adding more markets and I've got to start trading markets a bit smaller, but hopefully, as 2 years ago when I traded 100 markets, I traded 5 units, and now that I'm trading 170 markets, maybe I can trade 5.5 units and increase my overall risk a bit. But I think that if I went to 7 units, it would probably be fine. I would have a lot more volatility on the open trade equity, but I think I have my closed trade protection defending the closed trade equity and not allowing that to have much of a drawdown. I have that under control by all the other characteristics of my methods.
Yeah, this is very relevant actually, and thanks for bringing it up because I think I tripped myself up a little bit. I realized I gave the impression that my rules are elastic. Not at all. Rules are rules are rules. Signals get generated across, for all markets in the same way. They get applied to markets in the same way. There's a lot of rigidity in the rules. The result of the optimization is different. So, have varying portfolio weights that go through, across time, and they're function of three different things. One is risk, as perceived as my volatility parameter, which is not standard deviation, is adjusted for downside and upside. It's a bit like the serenity ratio, except it's not quite well. I don't do conditional drawdowns, but I take into account my drawdowns and I don't penalize my upswings at all. So one is volatility, the other one is correlation, and the third one is the strength of signals. So those weights of mine vary all the time, unlike yours, because you have one position equals 1 unit of risk, and 10 positions is 10 units of risk. However, you decide to choose your units of risk. In my world, my portfolio, my units of risk can change as a result of this optimization. So I want to clarify that. I don't change rules. I change allocation changes, only allocation through.
But I'm definitely choosing my maximum risk level by looking at how the diversification has impacted my historical volatility and drawdowns. So I am cheating and not paying attention to history. And I'm saying, oh, okay, if I applied 5 units since the 80s, this is the level of volatility that I'm comfortable with. And it could be a lot more. It could be way worse. And then I'll cheat a little bit more and say, well, starting in the 80s with my back test, I had 25 markets. And as I progress forward over time, now it's up to 175 markets. I can see that I can take a bit more risk currently because I see the benefits of adding these markets. And 5 units was more volatile back in the 80s than it is now with 170 markets.
So would that be almost subjective, as in like, there's a lot of rules that are systematic. You put those rules in, but when we come to unit size, are you looking at it from a subjective way? It's just saying like, okay, this is too much to handle. Let me just reduce it, or is there actually a real system behind it? That like system as in process that you go through before you make a change or that decision. Not that it has changed a lot over the years, but
Man, I think it's pretty subjective. I think that that's part of the subjectivity that you need to recognize in yourself. I'm never a fan of every. There's no right answer. Neil says that all the time. I never agree. There's no right answer. I mean, there is a right answer. I don't know it, but I hope to get closer to it. And some people do things better than others in every field, except trading. Come on, there is a right answer. There is best practices. There is this pursuit of doing things better. And so I do think that we should learn and hold ourselves to a high standard of trying to find that. But if there's one subjective thing you can do is like, oh yeah, I personally uh, trade. I'm not going to allow my personality to determine. I'm not going to take profits. I want to take profits. I'm a human being. I want to take profits, but that's wrong. And so I'm not going to allow my personality to say, oh, it's fine for me to have a non-robust elements to my system because that's my personality. No, stop. But it is okay to say, I want to do 5 units. My friends do 10 units. I don't want to have a 50% drawdown like Mulvaney. I admire him from a distance, but I need to have my risk level, my drawdowns, um, thinking in my head, I'll probably undershoot a bit and undershoot the level of the drawdown, even after saying, congratulating myself for being so conservative. But I want to choose a trade level and a volatility level that allows me to follow my rules and not override the rules. And I have done that many times over the years because, it wasn't that long ago, I was probably trading 10 units in a period where it was the worst 10 years for trend following. So, that had a bad impact on my performance because I was not allowing myself to follow my rules to the degree that I needed to, strictly because I was getting freaked out with lack of profits and bigger drawdowns. So I think you need to sort of ease yourself into that and figure out, and then I take Richard's warnings seriously because you don't want to start heading back up that mountain to 10 units and convince yourself, well, I'm going to be kind of protected because I've got 200 markets I'm trading now, and I've got this trade level thing under control now. Boom, the next thing you know, it's a COVID. Uh, and I hated that COVID period. We went from 9% profit to negative in a week or whatever. So that was a basket case. So you want to protect yourself in any way you can and make the bottom line having the rules and following the rules and making sure that your rules are not overly optimized. Because I listen to a lot of traders. Back in the day, I would sit in front of the quote machine and watch coffee, and then I would get out prematurely during a freeze in Brazil, and I would obviously beat myself up and say, well, that was wrong. You overrode your system. Nowadays, well, let's just write a rule for it. If you can write a rule to get out of coffee prematurely, then you're golden. Then no one can criticize you. And I think I see a lot of that going on. Oh, you have rules. But once again, I say, one entry breakout, one exit breakout, a stop loss. Okay, now once we get beyond that, we're getting into this situation of manufacturing rules because psychologically, I don't like drawdowns and I don't like giving back profit, even though when I run the back test, the classic trend following makes the most amount of money.
We had a good tweet, Jerry. I noticed it. You tweeted out the Mark Rezubcinski article in relation to human nature and the brain's tendency to, predict, create a narrative. This bias that is always sort of embedded in our assumptions. And it's interesting, because when you view how the human brain operates, you see this total application occurring in these quantitative methods to play a lot of attention on the historical track record. So the quantitative researcher uses history as a basis to define a model that then has this propensity to possibly work into the future. But that's exactly how our predictive brains operate as well, but through an evolutionary perspective. This predictive engine we've got has given us a narrative that makes us sort of understand or understand cause and effect, what's happened in the past. But it just shows how that sort of that tendency to rely on the historical data set is a real weakness in relation to survival when we can possibly face a totally different future. So it was a great little article you posted, and you know, I just tend to feel that there is so much now of quantitative data science that is focused on the data, and I think they miss the point that uncertainty has such a large part to play in future returns, and that will inevitably be underestimated through any model that is predictive in nature and assumes that the past is a basis to project any future returns.
You guys got to jump in because Richard and I always have something to say. But jump in whenever you're ready. You know, I think I took one of the things that confused me about that quote. I kept reading it, and I just didn't understand it. And the confirmatory bias of our minds favors uncritical acceptance of suggestions and exaggerations of the likelihood of extreme and improbable events. I just really found that hard to understand, in that trend following is built off of the opposite, which is we don't believe in the likelihood of extreme and improbable events. We are hunting the outliers as if it's the only thing to do. You're missing it. There's nothing other than divergent hunting, that nothing other is better. In fact, everything else, I think, has a potential to be devastating, um, being on the wrong side of an outlier. But then I honed in on, okay, maybe it's this likelihood. It's the likelihood. It's um, it's we think the likelihood is high, and the trend followers know the likelihood is very low. It's 5%. 5% of our trades are these outliers. But what people, and I go on to say, trend followers accept the likelihood of extreme and improbable events is very low. But the payouts of these low probability events, the uncapped profit potential, it's hard to exaggerate or overestimate how large that can be. So I tried to twist it into something I felt like that was true, but I think if you read it too quickly, so then I favored on percentage chance versus potential uncapped moves. And I should have I put hashtag outliers, but then later I was going, it's hashtag expectation, percentage wins times average win. So percentage wins can be very low, 40, 20, whatever, 10, you know. But the average win can be very high. And I think that's what that's what they underestimate. If not, then they'll all be natural trend followers.
Hi, everyone. Yeah, I'd like to hear the words like a human nature and a mind, how the human mind works. And like I totally believe that trend following, successful trend following definitely is counterintuitive. And we talk about human nature. And also, I want to put my 2 cents about China. I mean, since I was born in China, but I believe I'm more American than being Chinese. And I'm like sitting in the middle. I'm watching the two society evolving right in front of my eyes. So, I mean, we all know here, like we talk about human rights, democracy. These are the buzzwords. But I would like to be cautious about that because, you know, the propaganda machines, now I notice that in both countries are as strong as ever. So, and probably in these days in America, we all need what? Critical thinking. That's what we lack most. And I remember there's a interview. There was an interview. A fresh young face was interviewing Ray Dalio. Very interesting. Yeah, the young lady say, "Oh, what about the human rights in Xinjiang province?" And I feel like it's funny. And Ray Dalio seems like it was agitated. Say, "Okay, what about human rights? How do you know about what happened in Xinjiang? Were you there?" And I would say, "Oh my God." Maybe he's just too big to be canceled. I mean, for other people, he would be canceled. So yeah, so I believe the fall, the empire, the rise, the rise and the fall of the empire. I mean, this is a natural progression. So this is my 2 cents. Thank you.
Thank you, Lulu. That's whatever you want to say is fine. We don't know a lot of the details about what's going on, and this is not a political so Clubhouse. So it's fine. It would be good if I suppose if India and China condemned the invasion. But I really do enjoy politics, so I need to do a Clubhouse on politics one of these days. I think it'd be kind of fun.
And also regarding reserve currency, I don't know. I don't need to worry about that for another 30 years.
Can you expand on that?
Oh, sorry. This is just my gut feelings. But I will do some research. I'll talk about next time.
Okay.
Jeff and Andy, how are you going?
Hey, good. I actually had a comment, so I was about to. Thanks for asking. About what Jerry just said, and I hope I get it right. That's kind of why was hesitant to chime in. But it sounded like, and I might not follow the right Twitter account, but it sounded like the quote that Jerry said about trend following and essentially does it take into consideration and overweight extreme events? And in my opinion, it doesn't. And I think it depends on your perspective. It it actually is the opposite for me. And I think each trader has their own personality. But if I'm in a trade and I'm holding it, and holding it is difficult, and that's what I love about this chat room is we all give each other confidence to stick to our positions. But if I'm holding a position and it's going in my favor, I get very nervous the opposite direction of something that's an extreme event in the opposite direction. So, in my opinion, trend following is just very much um, against it. It helps me to not to underweight. I'm going to try not to be confusing. To underweight relative to my natural tendencies, to underweight the extreme circumstance. That's what I want to say. And I'm not sure if I understood the context of Jerry's quote. So there.
Oh, can you say the quote again?
Oh, I wish I could. It was when the one you said you weren't sure if you were understanding it right as far as the that maybe someone posted an extreme. It was what you had quoted. Something happened on Twitter that I guess I might not be following the right accounts, but somebody posted and kind of was accusing trend following of overweighting extreme circumstances.
Oh yeah. Well, I'm not sure. I don't remember that, but that's a good topic. Anyways, so yeah, I think this is confusing. I believe to some people, and maybe it should be more confusing to me. But it does rub people, I think, the wrong way. That when you do these back tests and you capture 90% of the trades that you capture are insignificant, and then you decide to use these systems and put your whole life at the mercy of these outlier trades, because it captures the outliers as well. So you're not looking at it as well. I have 5,000 trades. Oh yeah, some of them were these big outliers. I didn't even notice. Yeah, you noticed and you ignored. And is that a legitimate count of sample size that you're including 95% of the trades are close to zero profit and the other 5% made all the money? And some people will even say, oh, you should get rid of those outliers from your data set to see how good this system is. Well, it's not going to be any good. It was only decent, and notwithstanding the massive drawdowns, when you included those outliers. So I think that's kind of something that bugs some people. I remember starting Chesapeake in 1988, and then there was a article in like Futures Magazine or whatever with that very topic, analyzing turtle trading, and one of my colleagues or whatever, and saying, well, it's not a really great strategy. It relies too much on things that never happen. I know. And then so we have to remind ourselves, of the period we've been in here in the future when we have hard times, we don't see these big trends, and say, hey, remember back in 2020 and 21 and 22, this is what we lived for, and we crushed it. We nailed it. We had one opportunity and we got it, or we didn't do it as well as we wanted to. And we just are sitting and waiting. And I think criticizing trend following and criticizing this strategy, when it's totally due to these outliers, it's the criticism probably is more appropriate for the person who chose this, and say, why do you choose this? You've chosen on purpose a method that really has these infrequent winners, and it bugs the crap out of me.
Okay, now it makes more sense. Thank you. And I agree with you. I mean that's you can't pick and choose. Either way, exactly what you're saying. You can't pick and choose, exclude the outliers, and you can't pick and choose only focus on the outliers.
Is Ray Dalio a trend follower?
Well, I certainly don't think he would admit to it. They probably find other ways of getting in the trends. So, I mean, that's a very good question. Like, it would be really fun to see a systematic approach, trend approach, and compare that, and put in some stocks and wait. Try to figure out how many stocks did the global macro guys trade. Bacon and Jones and Dalio and all these famous guys. How much did they trade in the 90s and 2000s? Because that was the best market. And see how trend would have done versus those guys. That's a great thing to know. Is there anything better than just following the trends in the stocks? And yeah, it's I like that idea, but I don't think that they. I don't know if you can charge 2 and 20 and have this aura and collect billions and trillions in AUM and without at least pretending to do more than just follow the trends.
And I think that Red Dollar have certainly some elements, maybe I'm wrong, but have some elements of trend following, and I see this diversification. It's I think it's element of trend following for me personally, and he applies to his strategy diversification and this parity risk idea. Maybe it's not a trend following, of course, in a classical way, but something, according to this idea, something will grow. So we will see rising prices on one or two assets, and it will bring to us profit. So I see elements of trend following here, but it's a big question. Is it good or not? Isn't it better to be a classical trend following? And for me personally, there is no better way than to be a classical trend following, like Jerry teach us.
I've got a friend from undergrad who worked at Bridgewater, and he never got into the secret sauce. But I think in our conversations, I would loosely call it a vol-targeted macro trend follower, if you will, where they're catching their macro thesis on the breakout, but then kind of taking some off and then putting some back on, and taking some off and putting some back on in a quasi-systematic way.
But in fact, I see that the main factor of success of Ray Dalio, as I see it, it's a diversification. Uncorrelated return streams, as he said.
Absolutely, my friend, absolutely.
And probably being systematic, because when I read his book Principles, I learned how systematic he's been in his business and life and trading.
Yeah, he definitely knows more about China than we give him credit to.
Can you expand on that? When you say systematic in life, I have not read the book, but it's quite interesting to you that.
Well, and Ray was one of the. I say that like I know him, but I don't. I'm just saying that he helped set up the Chinese market. He was one of the Western managers they brought over to help set that system up, which is why he is kind of China biased.
Yeah, I agree.
I enjoyed that book.
I'm waiting for Jerry's book on the turtle principles to life and the markets.
Very good idea. Well, getting all the free, you could write the book yourself as listening to the podcast and watching Twitter, listening to Clubhouse. So the trend following thing, it's all out there. Someone said something earlier, I don't know if it was Bruno or somebody, about something that I said, and I'm like, oh yeah, you could say that. Not only did I say it recently, but I probably said it like 15, 20 years ago. I don't have a lot of original content. I think that's a strength and kind of a weakness, and that's why I'm so interested in listening to some podcast, especially Richard, and I like the new podcast that Niels has with Alan Dunn, and he's bringing in allocators who are somewhat favorable to trend. I thought that was pretty interesting, and I'll like to listen to these things multiple times and listen to them on YouTube and copy paste the quotes, because I learn a lot and slightly different perspective on how to say it better and think about it better. So yeah, but I'm just afraid, and I think this is a major problem. All of the great stuff that happened in that turtle thing, I don't think a lot of it made it into Covell books, and it's going to be lost. Covell was thinking about doing a movie. Now, I've told you guys I was in a movie once, and I had a speaking role, and I would just be perfect for this turtle movie, right? And because I really do think, I miss my calling of being an actor, and so I'm kind of, as I'm probably got a big smile on my face. I'm laughing. I'm trying to be funny. Everybody's on mute. I can't hear all y'all chuckling along, but yeah. So I do think this would probably be a pretty good idea. TV series, movie, whatever. But yeah, a lot of the great stuff with the turtles, and I definitely think that the big fancy European CTAs, they don't act like they know enough about how I'm going to get myself in so much trouble, but they just don't talk like they understand. It's okay if they dismiss what we were, our philosophy and strategy. They have to dismiss it. They'll just raise too much money if they pay it. If they pay too much attention to it, it's just going to hurt their brand. But you would think that they would want to tap into, like, we got to go out and get us a turtle, and we need to download all of this information. But it's not going to happen, and because they can't see what they don't see, and they yeah. But anyways, I'm going to sign off unless anybody has some parting words and want to keep going.
Jerry, would it be possible to activate the chat so we could drop comments or kind of things that maybe are small and incidental that don't require an interjection or something like that. I don't know if that's possible.
Oh, what is that?
There's just a little chat bubble, and when I tapped on it, it said that it wasn't configured for our Clubhouse.
Oh yeah, I see that. I'll work on that.
Thank you, sir. And just so that you know, most of us on here are Kool-Aid drinkers, so we were taking you seriously, not in a comedic fashion about the turtle movie.
Yes, very good. All right, guys, it's been fun, and hope you have a good weekend and happy, safe trading. And see you next week. Same time, same place. Have a good weekend.
Thanks, everyone.
Thank you
Be
so
safe.
much.
Thanks, guys.
Bye.
Have a good
Bye.
day. Have a good week.